Okay, we're getting started a little bit late. I had to get logged into everything. What we're going to do today, we're going to finish chapter 7, which is stock valuation, and then I'm going to pull up some information on stocks, and we're going to take a look at some stock prices, stocks changing prices, and we're going to kind of go over the basics of how do you open an account, how do you trade, what does some of the terminology mean when you're looking at a trading account, that type of thing. One other piece of just real world advice, and it's actually somewhat ironic since I teach classes on how to avoid this, but let's see, I don't think I told this class about my tax return. Did I tell you this? I don't think it was this class. Monday, I got a form in the mail from the state of Kentucky off the Department of Revenue saying that we want to verify your identity based on your tax return that you have submitted. So I thought, okay, I'm not sure if this letter is a scam or not. You have to be pretty careful. They wanted some information. So that was one thing that I kind of worried about. The main source of concern for me was that I had not yet submitted my Kentucky state tax return. So I got on the phone Tuesday, called the Department of Revenue. I went to the official website so that I could make sure the number that was listed on the letter wasn't some scam that they wanted you to call. So I called and they said, yes, you surely have. Somebody has submitted a state tax return for you. It is out of the state of New Jersey, or they submitted it and they had to ask some questions, and they thought it was kind of funny that I teach classes on how to keep your identity from being stolen and all of that. But we got that taken care of. So hopefully that's taken care of. Well, I had submitted my federal tax return on Tuesday afternoon. Yesterday, and I had submitted electronically, which I've done for the last 8 or 9 years. Yesterday I got a rejection notice saying that somebody had already submitted a federal tax return using my Social Security number, and that they had rejected my federal tax return. So that's why I'm late getting here today. I've been on the phone with the IRS this morning, and you spend a lot of time on hold the week that taxes are due. They're actually not due until Tuesday the 18th this year, but that's beside the point. So finally talked to them, got to submit paper returns to them, and it's just a huge headache. So don't ask me how anybody got that information. I'm really careful. I'm probably as careful as anybody can be. The only thing that I can think of is a couple years ago, the university's insurance carrier, Blue Cross Blue Shield, had a data breach, and they stole a lot of identities, and mine could have been one of them. So apparently, I don't know how or why, but that's just something that in the future, if you see something like that, I mean, it happens. Hopefully, it's going to get resolved. I checked my credit report immediately yesterday to see if anything odd had showed up, and there was nothing in terms of credit cards or any of that. So again, that stuff just happens, and so that's what I've been dealing with this morning is, excuse me, the Internal Revenue Service. So there's not a much better way to spend your morning than dealing with the IRS, other than walking into a cool classroom. Okay, that's probably the saving grace to this. All right. Now, let me remind you, quiz number 5 on stock valuation, which we covered all the information that you need to know on Tuesday. It is currently open in Canvas. It will be open until Saturday at 11:59 p.m. You get your 5th quiz finished, your highest 4 quiz grades count, and then we're finished with the quizzes. And all we have to worry about is the final exam and the bonus exam, which are going to be on the same day. And I think it's Tuesday of finals week at 1:30 maybe, something like that. We'll talk more about that later. All right, now we've been talking about stock prices, and we're going to look at some stock prices in a minute. But before we do that, I want to talk for just a second about what's called the efficient market hypothesis. And you can see sort of a multi-part definition here of the efficient market hypothesis. And so what it says is, now when we talk about market, we're talking about our stock markets. It says security prices or stock prices are normally in equilibrium and fairly priced. An investor cannot beat the market except through good luck or inside information. Now, it continues on. It says security prices or stock prices at all times reflect all public information, and prices react swiftly to new information. The efficient market hypothesis does not assume all investors are rational. Now, let me kind of explain what those first two items are saying. The first bullet point, what it says is, if you look at the stock market, which we'll do in just a minute, we're going to take a look at, this is what it's going to look like, and I'm actually going to bring it up just to kind of keep from being logged out of it. But this is what we're going to be looking at. And you can see the prices here. You can see these prices constantly changing. So that's what the green and the red mean. The green means a tick up in price. The red means a tick down in price. So you can see every second just about, these stock prices are going up or down. And these are companies that you're familiar with. This is Ford Motor Company, Facebook, Citibank, Tesla Motor Company, First Solar, Twitter, British Petroleum, Netflix, Chipotle Mexican Grill, and Under Armour. You've heard of all these companies, okay? And what we'll do in just a minute, we're going to go across and talk about what do all these things across the top of this, well, I guess, I don't know what you call it, graph or table or whatever, is showing. But, I mean, you can watch, for example, Facebook. You can watch the price change against about $139.75. Maybe it'll change here. Okay, now it's $139.73. Now it's $139.74. Now, going back to the efficient market hypothesis, what this says is that if it says that the price of Facebook is $139.74, that should be the exact correct price at that second. And the second part says investors cannot beat the market. What that means is outperform a market portfolio of stocks, and that will be something like a stock index, like the S&P 500 or the Dow Jones Industrial Average. You can't outperform the market consistently. Now, they don't give us a definition of consistently. So does that mean 3 years in a row, 5 years in a row, 10 years in a row? You know, what does consistently mean? But it's saying that the average investor can't outperform the market. And stock prices at all times, like the ones we just looked at, reflect all publicly available information. Now on Tuesday, I said that stock prices, a big part of investing is signals, positive signals, negative signals, and how investors like you, how you interpret those signals. I mean, that's a big part of this. And so again, we'll take a look at that in just a minute when we look at the stock prices. But when these signals come out, it says that prices react swiftly to new information. Now, lots of studies have been done on this. What it shows is that typically stock prices will normally react within 3 to 12 minutes, depending on which study you look at, when information comes out. So within 3 to 12 minutes, investors digest that information and they think it's a positive, which may push the price of the stock up. It's a negative signal, which pushes the price of the stock down, or it's simply not going to have any effect in it. Just has a very marginal effect on the price of stock. But again, signal is very important. And the last thing here says that not everybody believes in the efficient market hypothesis. You're looking at one person who doesn't believe fully in the efficient market hypothesis. Because I think that investors overreact in some cases to information. They underreact in some cases to information, and as an investor, you can take advantage of that because I think that some stocks are temporarily underpriced or overpriced. And so we'll take a look at this when we look at the stocks in just a minute also. Okay, now what the efficient market hypothesis says is, it continues, if stock prices deviate from their intrinsic values or their true value, investors will quickly take advantage of this. So what it says is, even if they're mispriced a little bit, investors are going to see this. They're going to buy or sell until the stock goes back to its equilibrium price, which is the price it should sell for in the first place. And the last part, it is possible to have irrational investors in a rational market. And we do. I mean, you all may know people who have bought stock. They don't know anything about buying stock. They just decided, hey, I drive Ford cars. I like Ford cars, so I'm going to buy some shares of Ford Motor Company. And that's the basis on which they buy Ford Motor Company stock. Or I see, everybody wearing Under Armour apparel. Apparently Under Armour is a good company, so I'm going to buy shares of Under Armour stock. And that's what they base it on, okay? Now, I'm going to pass this around. This is something that, speaking of Under Armour, I received this last night. This is a proxy statement. So this is what they send out on a quarterly basis. And it's just, for example, if you're a stockholder in Under Armour, you would receive this. This is 20 pages of a 78-page document. Okay, I didn't want to print off 78 pages, but this is 20 pages. And so what it does, it basically talks about Under Armour. It talks about who's on the board of directors, who's up for nomination and for election for the board of directors. It talks about the founder. It tells how many shares that the founder owns. For example, Kevin Plank, who's the founder, currently owns 34,651,491 shares of Under Armour. That's a pretty good investment, 34 million shares. That is 15.8% of the outstanding shares. That's Class A and B shares, and then of Class C shares, he owns 65%. So you can see he is in control. He's the founder. He has controlling interests, and he's going to run Under Armour as long as he wants to. But then it has some of the others listed here. People who own 100,000 shares or 20,000 or 50, whatever. So I'm just going to pass this around. If you want to take a look at it, you can kind of thumb through it. I'm also going to put this on the Canvas page, so you can take a look at the entire PDF file if you want to. But this is just something that you'll receive if you invest in the stock market. Now, when it comes to the efficient market hypothesis, there are 3 different forms of efficiency, or 3 different strengths of efficiency. So we're going to start from the weakest form, which ironically is called the weak form efficiency, and move to stronger forms of efficiency. So, weak form efficiency, when it comes to the efficient market hypothesis, says that an investor can't profit by looking at past trends or historical information. So if I'm sitting here and I'm looking at this proxy statement, or I'm going back and looking at charts of what's happened with a certain stock over the last 5 years or 10 years or whatever, that it's not going to help me when it comes to investing. Now, our markets have been proven, and this has been studied a lot, they have been proved to primarily be weak form efficient, which means that you can't consistently beat the market by looking at historical information, which is a good thing about our stock markets. Because if somebody could, then investors might question, should I really invest in the market? Should I not invest in the market? Because when we're talking about efficiency, this is one key thing that's really important to our economy. If we lose confidence in our stock market, you're going to stop putting money into it, and that is going to severely cripple our economy. That's how it is. And we don't necessarily have to worry about that too much, because we know that our stock market is so large that really one person or even a group of people can't necessarily control the stock market. But if you're in a smaller country, such as, and I'll give you an example of this, a few years ago, did we have another wasp out? Wow, it's wasp killing season. All right, send it down this way. I'll take care of it. There must be something special about this class. I mean, you guys you bring out the wasp. Oh, here he comes. Here he comes. I don't know if I would have slapped him onto her or not, but okay, that's okay. You might want to look very closely around your feet since you have sandals on. And oh, here he comes. Okay. Wow. I knew we needed some excitement in this class. Okay, that's. All right, hand of applause, hand of applause. All right. The people listening to this in the online class are going to think we're crazy in here, okay? They're going to hear this screaming and shrieks and all of this, okay? Just to let you know, we did have another wasp outbreak, so we took care of it. All right, now where were we? Oh, weak form efficiency. Our markets have been proven to be weak form efficient. What I said was that some small countries, an example of this is the country of Cyprus. I've been to Cyprus to teach several times, and I was teaching a class there one semester on investing. And I started talking about the Cypriot stock market, and some of the students were kind of looking at each other and kind of making some comments. And it was a small class full of typically, they were mostly engineers. And so I said, you know, what's the deal here? And they said, well, most of us, or I think it might have been all of them, don't invest in the Cypriot stock market. And I'm thinking, you know, okay, you're very educated people. You make pretty good money. Why don't you? And they said, well, our stock market is so small that very wealthy individuals can manipulate the stock market to make it do what they want. I'm like, well, that could be a problem because you don't want to invest your money in something where one person could cause the market to go up or down based on what they want to happen and not necessarily what you think is going to happen based on your research. So really small stock markets have more trouble than, say, the United States stock market. Now, the next level of efficiency is something called semi-strong form efficiency. And what this says is that all publicly available information is reflected in stock prices. So it doesn't pay to pore over annual reports, SEC filings, like the one listed here, newspaper articles, websites, whatever, okay? And the United States stock markets have, for the most part, been proven to be semi-strong form efficient, which again means that the average investor probably can't outperform the market. So again, that's good and bad. Now, the third level of efficiency is what's called strong form efficiency. And what this says is that all information, even insider information or private information, is included in stock prices. So what this means is if our stock markets were strong form efficient, investors could not make unusually large profits even knowing inside information. Now, this is not true because, I mean, you've seen it in the news. If you have access to inside information that other investors don't have access to, you could make large profits in the stock market. The only problem is it's illegal to do that. It's called insider trading. Now, does insider trading happen on a regular basis? Yes, it does. Has it happened today? Yes, somewhere it has. Has it happened probably 100 times today? Yes. The problem is it's really tough to prove insider trading. And, you know, you've heard stories of Martha Stewart. Everybody's heard of Martha Stewart going to prison for, most people think she went to prison for insider trading. Actually, she did not go to prison for insider trading. They couldn't prove it, but she went to prison for lying to federal investigators. That's what she went to prison for. But it's tough. For example, let me give you an example of this. Let's say that I am an attorney for a bank. And another bank is going to purchase my bank. We're going to make the announcement next week, and they're going to pay 2 times book value for my bank stock because they really want to purchase our bank. Now, it would be too obvious if I just logged into my account and bought several shares of my bank stock before the announcement because I know it's coming. That's illegal. It would be pretty easy to prosecute. But what if I picked up the phone, I call my mother, and I say, hey, Mom, don't ask any questions. just get together as much cash as you can, buy as many shares of my bank stock as you can today or this week, and just wait until next week. Watch the news. And I hang up. And so she's thinking, what's that all about? Well, I don't know. Why is he asking me to buy shares of stock in his bank? I don't know. Maybe he knows what he's talking about, so she does it. Let's say she buys $10,000 worth of stock. So the next week, the announcement comes out, another bank's buying my bank, the stock price doubles, and my mother has doubled her money in less than a week. Is there anything wrong with that? I mean, it's my mom. If you can't help her, who can you help out? I mean, can't we just call that being in the right place at the right time? Or maybe knowing the right people and just leave it at that and move on? Do what? I mean, what's wrong with that? Because it is illegal. Who was that? Some people say, well, that doesn't hurt anybody. Well, it does. Who does that hurt? That's exactly right. It hurts the other people who don't have access to that information. Because there might have been somebody out there who, if they would have, let's say they were selling stock in that bank that day. Even the person who sold my mother the stock that she bought, if they knew it was going to double the next week, they wouldn't have sold it. So insider trading hurts investors who don't have access to inside information. And again, what that does is that takes confidence away from our stock market. And if we lose confidence in our stock market, we're going to stop investing. And it is a multi-billion-dollar per day institution. So what would happen? Well, it would, as I said earlier, it would cripple our economy if the stock market collapses. I mean, it would really, really be bad for the economy. Now, there's stories of insider trading everywhere. There are people who hear stock tips from friends. Now, keep in mind, when you're listening to this information, somebody's giving you a stock tip, you have to consider the source. So if somebody's telling you, hey man, you need to buy, shares of Under Armour because I just heard that they came out with this new, brand new wearable technology that's going to blow every other apparel maker out of the water. So you need to buy shares of Under Armour. Well, if you're getting that information from a friend of yours who drinks way too much and hallucinates occasionally, you might want to think about that. If you're getting that information from somebody who maybe studies athletic apparel makers, they invest heavily and they maybe can see this coming, that's something else. Now, if you get it from somebody that's an insider in the company, you are actually guilty of insider trading. But again, they have to prove that, and that's really difficult to do. But insider trading is not unusual, but it is illegal. So you need to know that the United States stock markets are weak form efficient. They are semi-strong form efficient, but they are not strong form efficient. Okay, so know that for the final exam. And then, basically one of the reasons that our stock markets are so efficient is because we have so many professionals watching the stock market. This says we've got 100,000 or so trained professional stock analysts whose jobs it is to watch different companies in the market. So we've got, they're working for Fidelity, JP Morgan, Prudential. They've got access to the best data. They've got access to the most recent data. They've got access to company insiders. And so if something happens within this company, it's kind of silly to think that I could, a company like Walmart, a huge company, I can log onto my computer at night, spend 20 minutes researching Walmart, and it's kind of silly to think that I can learn something that the 500 professionals who spend 16 hours per day watching Walmart stock, that I can know more about Walmart than they do. And so it's typically with the big companies, it's really hard to find mispriced large companies. But there are small companies that sometimes they sort of fly under the radar, and I think that you can, if you do your research, you can find small companies that are underpriced that make really, really good investments. Okay, now that's not saying that big companies don't, it's just saying that you won't outperform the market or make excess returns typically with the bigger firms unless there's some kind of overreaction. All right, so let's see. All right, now what I want to do, that is basically chapter 7, the information from it. Now what I want to do, we're going to switch over to this for a minute, and let's see if I have an option to make this larger. I don't think so. I'm afraid I'll mess it up. I'm just going to leave it there. Okay, so now what you see here, this is Scottrade. There's a lot of good online trading companies. Scottrade is one of them that I use. I've used it for several years. The reason I like it is it's consistent, it's reliable, it's fast. When you make a trade, it typically happens within a second. And it's fairly cheap, $7 per trade. So if you buy stock, $7, no matter how many shares you buy. If you sell stock, $7, no matter how many shares you sell. Now this is what's called Scottrader Streaming Quotes. And this is just one of the things that you get when you open up a Scottrade account. There's nothing really special about this other than typically when you look at stock prices, normally they're delayed 10 minutes, possibly, or 15 minutes. And that may not sound like a lot of time, but as you can see, these prices are trading, and they're changing every few seconds. So if you wait 10 minutes, there could be some pretty large changes occur. Now, as I mentioned earlier, you can see the ticker symbols here. So Ford, Facebook, Citibank, etc. And I'm going to go across the top and sort of explain what each of these are. Now, this is the last trade price. So as you can see, the prices are changing as we speak. This is the previous day's close. So, for example, let's see, what's moving the most today? Okay, Citibank is really moving a lot. All right, we'll focus on, it's not moving much. Let's focus here, Chipotle Mexican Grill. It's moving the most. So it's selling currently for $464.12.5 per share. Now, as I said earlier, back in chapter 3, when we're doing ratio analysis, you can't necessarily judge how good a stock is just by the price because, we can't tell how expensive it is or how cheap it is. You can see a lot of stocks selling for much less than $400 per share. For example, Ford Motor Company. Every stock here pretty much is selling for less than Chipotle. But of these, Chipotle is probably the worst stock listed here in terms of investability and the question of what's going to happen in the future. Because Chipotle's had a lot of negatives in terms of health concerns, salmonella outbreaks, and it's been trying really hard to get its customers back, but it's kind of a slow process. Okay, so this is yesterday's closing price, $458.35. So in terms of dollars, today Chipotle is up $5.96 per share, which equates to a 1.3% increase. So just today, they've increased by 1.3%. You could compare that to your savings account at the bank that may be earning 0.25 of 1% for the entire year. So you can see how you can make more money in the stock market, but you could also lose money in the stock market, because if you take a look at the ones in the red, these are the stocks that have lost money today. Okay, and you can see the percent. For example, First Solar has lost 1% today. British Petroleum has lost 1% today. This is the last trade size. So this is how many shares traded. So Chipotle, the last size was 10 shares. This is the daily high, 466.77. This is the daily low so far, 455.51. And these three items here, these are just rankings. This is S&P ranking, Thomson Reuters, and this is Second Opinion. They're just giving their as it says, opinion of what they think is going to happen to the stock in the future. So for example, here, if you see a 4-star rated stock, that would be considered better than a 3-star rated stock. Here, they give a neutral, a positive, a negative. Like for Chipotle, for example, they've got it listed as a long position. That means they're saying Chipotle would probably be a good stock to buy right now because of what may happen in the future, okay? And you can see the bid and the ask price. Now, I want to talk about this for just a second. Notice that with these stocks, for example, for Chipotle, the bid price, the ask price is higher than the bid price. So there's a difference. Now, with a stock like Chipotle it's got a really high price, you can see that there currently is, almost a 60-cent difference in the price. Let me tell you what each of these is. The ask price is if you want to buy a share of stock, you're going to pay Scottrade the ask price. The bid price is if you want to sell your shares of stock to Scottrade, they're going to pay you the bid price. So you're going to pay more if you buy it than they're going to pay you if you sell it to them. Now, I said that Scottrade makes $7 per share, or per trade. Also, they make the difference between the bid price and the ask price. It's called the bid-ask spread. Now, you may look at this because on most stocks, it's only 1 or 2 cents. For example, if we look at Ford Motor Company, it's 1 cent, 11.13 versus 11.14. And you may think, wow, 1 penny. They're making it 1 penny per share. What's the big deal? Well, it may not be a big deal unless you're selling 20, 30, 40, 50, 100 million shares per day, and then that penny per share adds up. So you can see as we go across the volume, you can see that today there have been 22,016,145, well now it's 857, shares of Citibank bought or sold. That's just today in 3 hours, 22 million shares. Now, of course, all of them haven't been bought and sold through Scottrade, but they have been bought and sold. Now, this is a pretty slow day, actually, because some days you may see over 100 million shares of a certain company that's already been bought or sold in the first 3 hours. So you can see this is a huge market. Oh, I can, yeah. Well, let's see here. Let's go to United. Let's go to Manage List. And let's add UA. And let's save it. See if that helps. All right. I want you to disappear now. Get out of the way. Okay. So here we go. Here's United. I think what you're going to notice is, let's see, so United, I think this is United Airlines. So maybe we'll check that for me just to make sure that the ticker symbol is what? UAL. Okay, I thought there's not much happening with this stock. Okay, so let's change this. I think I can do it here. UAL. Okay. So again, not just a lot of, they've got it rated as a void. But then this rating service has it listed as a positive, and it's listed as a 5-star rated stock by this company. So now again, these aren't always updated daily. Okay, sometimes a lot of these aren't updated for maybe a month or even 2 months. So, but what I'll do is in a minute, when we take a look at a graph, I'll pull up a graph and take a look at the last few days, and we'll see what happened to the stock. Okay. So you can see the volume here, and then this is the time of the last trade. So there's a ton of information here. Now, if you wanted to buy stock or sell stock, you can go to the official Scottrade page, log in, and you can put in your buy or sell. Or if you're at this point, let's say, for example, let's say I'm here, and I want to buy or sell, whatever. I'm just going to pick on United Airlines. I want to buy or sell United Airlines stock. Well, I could just click on the buy, and it's going to bring up this screen. Now, let me explain to you what this is. And you'll notice here, First of all, this is the ticker symbol. This is the information. So this is United Airlines. This is the bid price. So I would pay the ask price. This is the last trade. You can see this changing as we speak. The volume today, so only 3 million shares have changed hands, so there's not a lot happening with it. And the time of the last trade. This is Eastern time. Okay. Now here, again, I can buy, I can sell short, or I can buy to cover. So this would be a buy transaction. Here's the symbol. And let's say I put in the quantity. Let's say I want to buy, I don't know, 10 shares or 100 or 1,000 or whatever it might be. Now, the order type, this is a drop-down menu. A market order simply means when I press that button to buy 10 shares of United Airlines stock, I'm going to pay whatever this price is at that millisecond. Okay? It's not that second, it's that millisecond. Now, what if I don't think that United Airlines is worth $69.56? No, $69.58 per share. Maybe I think it's worth $65 per share. But I don't want to stand here in front of the computer and watch it and hope it drops to $65 per share. What I can do is I can put in what's called a limit order. And a limit order would be here. I'll use the drop-down menu. You can see some others. They work basically just like kind of like a limit order, but I'm just going to stick with this. And then what it's going to do, it lets me put in a limit price. And so my limit price, let's say I want to buy at $65 per share. What this means is when United Airlines, if it does drop to $65 per share, it would automatically send my order in and buy the shares at $65 per share. If it doesn't reach 65, it's not going to complete the order. Now, here it says time in force. So I've got three choices here. I've got a day order. I can have a GTC, which stands for good till canceled, or I can have a GTD, which stands for good till a certain date. So what this means is if I place this limit order as a day order, today when the market closes, if it hasn't completed this order, it disappears. It's in effect no longer, okay? A good till canceled order means that if I put this limit order in at 65 to buy 10 shares, it's going to stay there forever until it's either executed or I go in and physically remove it. And then a good till date means simply, let's say I want this order in effect for the next week, and after that, I'm not interested in having it in effect anymore, so it'll disappear after the date that I put in. Now, I will warn you, you can put in some of these orders, for example, good till canceled orders, and you can forget about them, especially if you're buying and selling stock fairly often. And then 3 months later, you'll be sitting at your computer, and all of a sudden, it'll pop up that you just bought, whatever it is, 50 shares of Under Armour. And you're like, oh, yeah, I remember that. I put that limit order in, okay? That happens. So that's why this good till canceled or the good till a certain date might be more effective than a good till canceled order, is because you can set the date, okay? You may end up buying or selling shares that you actually didn't want to sell any longer, but you forgot to remove your limit order. Now, the trading session here, I don't think I have a choice here with this. With some stocks, they're going to have what's called after-hours trading. With this one, you don't have that choice. You just got a regular trading session, but this drop-down menu, if it was allowed, would say either regular trading hours or after hours. And then this qualifier, this is if I'm buying this stock and I only want to buy 10 shares, I can either set it as all or none, which means when I purchase this stock, no matter what type of order I'm using, if they can't buy all of the shares at once, I don't want them to buy any of it. Now, with 10 shares with a big company like United Airlines, that's not an issue. But if I'm a big investor and I want to buy, for example, 10 million shares, which is a big chunk, Scottrade and other brokerage companies, they have an inventory of stocks. So just like you go to Walmart and they've got an inventory of toothpaste, Scottrade has an inventory of United Airlines stocks, Citi Group stock, Ford Motor Company stock, Under Armour stock, and so typically they can fill most orders from their inventory that they own. But occasionally they have to go out into the market, buy the stock from somebody else, and then sell it to the person placing the order. So with a small order, this is not a problem, but with a big order, and I'm concerned about even the price changing a penny or two, then I may put this in, okay, all or none. But typically, you wouldn't have any kind of qualifier. Now, in going back, let me make sure I get rid of this before I accidentally buy 10 shares of United Airlines stock. I'm going to go back here. And let's take a look at a graph of United Airlines. Okay, so I'm going to go back 60 minutes. Okay, we can go back 2 weeks. I don't really like that. Let's see. About 30 minutes. Okay, this is not helping a whole lot. Okay, you can look. You can see here though, if you're taking a look at United Airlines stock, you can see that on April 11th, you can see they down here at the bottom, April 11th, that, I mean, they had a pretty significant drop from here to here, okay? And, of course, if you've seen the news lately or read anything or watched your Twitter, whatever it might be, you've seen about the passenger and everybody being upset about that, and United Airlines initially saying, no, you know, we didn't do anything wrong, then saying, yes, we did. And so you probably had some people dumping United Airlines stock, other people saying, man, this is going to really hurt their ticket sales going forward. So again, this is just the market's reaction, which is what I've been talking about, to what most people see as a very negative event. Now, is it going to hurt United long term? We don't, who knows? You know, I don't know that, but it could possibly. I'll give you another example of this. Let me go back here, and let's go to British Petroleum. And what I want to do is I want to go back. I don't know if I can do this daily or not. No, I've got to go back weekly. So I go back weekly, and I'm going to go back 10 years. All right, so I think most of you are aware that British Petroleum in 2010 had an oil spill. Okay, so their Deepwater Horizon oil well off of the Gulf Coast basically had a leak, a huge leak, and so you had oil drifting onto the Gulf Coast, which is where a lot of people vacation. It got national attention, world attention. I mean, it made it look like the Gulf Coast was covered in oil, and it was never going to come back. And it killed every fish in the ocean, and you know, it was just it's a huge natural disaster. Now, it became pretty apparent that this was going to cost BP lots of money. Okay. So if you take a look at this graph, this goes back 10 years. And if you take a look at, let's see, where are we here? Okay, so this is, here is April 10th. So you notice before BP was at about $80 per share. We go through, here's the oil spill. Let's see, where are we here? April. Let's see, where are we? Okay, here we go. Here we go, April 12th. Now, when the oil spill occurred, it took a day or two for them to figure out, you know, how bad is this? Well, it didn't take long for them to figure out that this was going to be a problem, and they couldn't cap this, and it was going to keep spewing oil into the Gulf of Mexico for a while. And so you'll notice the stock price here. So this is April 19th. It's a little bit after a week later. And BP pretty quickly said, look, we're going to set aside a minimum of $20 billion to compensate people who have lost income and to clean up this oil spill. Well, take a look at what happened to the price of the stock here to here. That's what I mean by an event occurring, investors processing this news and determining this is going to be a negative, this is going to be a positive, or it's going to have no effect. In this case, investors said this is going to have a very negative effect on BP stock, and they sold a lot of it. Supply exceeded demand, so the price was pushed down. I mean, that's how the stock market works. It's simply supply and demand. It's the stuff that you learn in your basic economics course. But now you'll notice that BP, you know, they've kind of clawed their way back some over time. But then right around in here, this is where you had oil prices dropping. And so the oil companies, they tend to do really well if oil prices or, you know, if gas prices are $3.50, $4 per gallon, which it was here. But here, when you get oil below $50 per barrel, you'll notice their profitability suffers a lot. And again, this is just one company. I mean, you can take a look at, you know, at any of these companies and get this out of the way. Ford, Facebook, Citibank. Citibank's pretty interesting. If you go back and take a look, 5 years, we'll go back 10 years. Okay, if you are an investor, this is what you do not want to see. This big drop in your stock's price. You want your chart to be going the other direction, okay? Notice Citibank was trading, I mean, it is trading at huge prices, and because of the financial crisis in 2008, 2009, the bailouts, all the problems, you can see, you know, if you were a stockholder here, and each day you kept thinking, it's got to go back up, I'm going to hold on to it. It's got to go back up, I'm going to hold on to it. You're pretty sick at this point. You have lost a ton of money. And notice, I mean, even though, I mean, of course, this is over a 10-year period, so if we went back and did this, for example, 60-minute, let's do this weekly. We'll do it daily. And we'll go back for the last 12 months. Now, you're going to see a pretty good climb in the stock price, okay? And it's going to be starting right around election time, because banks are heavily regulated. All banks are heavily regulated. Citibanks, which are the huge banks, and the Murray Bank, which is a small bank. But what people were thinking is, okay, if Republicans are elected, then they're going to reduce a lot of the regulations, and they're going to allow banks to hopefully kind of operate a little more freely, which should mean more profits, which should mean a higher stock price. And so that's what you saw happen here. Now, again, is that going to happen? We don't know if that's going to happen. This is just what investors think is going to happen. And if you took a look at, they actually had it on the news, the night of the election, when reports are coming in, when it looked like the Republicans were actually going to win the election, you saw the stock markets initially diving. They were down hundreds and hundreds of points. And so what I'd done is with my Scottrade account, I'd moved over because I'm thinking, okay, banking stocks, they're going to take off from this. So I'd moved over that night. I was on my computer watching the election returns, and I moved over $5,000 into my Scottrade account in cash, thinking tomorrow morning, market's open, I'm buying either mutual fund shares of financial institutions or individual shares of Citibanks or whatever, because the market was down so much. Well, by the time I was up the next morning, by the time the market opened, guess what had happened? They'd already shot up from their lows past their previous daily highs. So I missed out on that opportunity simply because other traders around the world, because keep in mind, the United States stock market, of course, it operates during our day, but then the trading day goes to Europe, goes to the Middle East, goes to Asia, and then it comes back around. So stocks are being bought and sold on stock markets 24 hours a day. Investor there had already taken advantage of this. So by the time I could purchase, that opportunity had already disappeared. But again, this is just kind of the nature of the stock market and what happens. Now, what I've got here, I've got some screenshots of this. Now, what you'll notice is these screenshots are pretty old. And so if you take a look at some of the prices here, for example, Facebook, I don't remember what date this was, but Facebook was selling for $23 per share. If you look at the graph now, Facebook is selling for $139 per share. That's a pretty good increase on your money. You could look at, let's see, what else do we have here? Citibank, Tesla Motor Company. Tesla was selling for $32 per share. Now, I don't even want to look at this. It's at $305 per share. Okay, so you can see stocks can be fantastic. They can be great investments, okay? But you need to understand what you're doing. You need to have the money that you have to understand you can lose money, and you have to be ready to lose that money. But again, if anybody has any questions about this, if you want to talk more about this or talk about how to open up an account or whatever, feel free to come by and see me. Okay? All right, that should be all of chapter 7. Remember, your quiz number 5 is open. Are there any questions about anything, by the way, before I let you go? All right, I'm going to go try to restore my identity, okay? Everybody have a great weekend. Be safe, and I will see you back here on Tuesday.